think about bond valuation, the three critical components to think about bonds are, firstly, the yield is made up of expected inflation, a real yield component, and a risk yield component. In terms of real yield, there the main guide would be the central bank, the policy rate, which is currently sitting at 5% versus inflation of very close to 5%. And that gives you your basis for the real yield component. And of course, you're not going to look at where the real yield is today, because if you're talking about a 10-year bond, it's where do you think the real rate will be over the 10-year period. But, for example, in the current environment where we're going through a protracted period of low real rates, it means that your real yield component of the bond curve will be relatively low. The second thing is that you've got to look at forecasts for inflation. And here, again, you should theoretically be looking at forecast inflation for the life of the bond, not just simply for the next period, which makes it difficult because we don't have inflation forecasts typically beyond 18 months. So what I often would do is I'd just simply use inflation expected in 1 year's time as my proxy for my long-term inflation. And then lastly is the risk component, which essentially is what if something goes wrong, but then most specifically, what if something goes wrong with inflation. So it's really called an inflation risk yield. And that sets your basis for evaluation. So in the current environment, we're probably talking about a real yield in the vicinity of 1%, because now I'm extrapolating it over a longer period, even though the current real yield is 0. You've got expected inflation at the 5% area, which puts you up to 6%, plus then a risk component, which often I just simply use around about 1% or 100 basis points, and that puts you at 7%. And this gives you a very rough way of how to calculate a fair value for bonds. Now, outside of this, you would then want to consider what might deviate the bond yield away from the fair value. And here you could highlight issues like financing of the government. They are by far the largest issuer in the bond market. So when the government starts to run very large fiscal deficits, then you find that the bond yields will start to move higher, bonds going cheaper, away from the fair value estimate. Equally, if you start to get worried that there are increased risks in the economy, be it political, be it risks to the rand due to uncertainty about the mining sector, you'll also find that this has a negative influence on bonds. Conversely, what in fact has been happening over the last few years is that global growth outlook has mattered a lot in determining bond yields. And the reason for this is that we've had central banks responding to softer growth by cutting interest rates and bringing the real yield down. So at the moment, and it's not usually the case in history, but at the moment, expectations around growth forecasts matter. And as expectations for growth forecasts are revised lower, it means that people start to think that the real rate is going to be brought down, and therefore it is bullish for bonds. So these are the type of factors that I consider when I think about bond valuations and the outlook for the bond market.